So imagine a master switch, right?
Right.
One that can just, well, completely freeze an entire nation's economy.
Right.
And it isn't some military deployment. It's not a central bank abruptly hiking up interest rates. It is, and this sounds mundane, but it's true, it's a highly specific string of 40 characters printed on a grocery receipt.
Or, a supplier's invoice.
Exactly. Without that exact string of characters formatted in this incredibly rigid way, conducting business legally effectively just ceases to exist. Welcome to the deep dive, everyone.
Yeah, we are looking at a document today that really strips away that whole illusion of a free-flowing, chaotic market, and it replaces it with this rigidly enforced data pipeline.
It's wild. So for our deep dive today, our source material is the Sri Lanka Gazette Extraordinary Num 248122.
Published on Friday, March 27, 2026.
Right. And our mission here is to really explore the anatomy of a standardized tax system. We're looking specifically at Sri Lanka's new mandatory value-added tax, or VAT invoice rules.
Because, every time you buy a coffee or pay a vendor or just scan a barcode at the store, there's this massive data operation happening in the background.
And this Gazette is honestly a masterclass in how a government captures all that chaotic economic data and just forces it into a format that an algorithm can audit in, like milliseconds.
Exactly.
Yeah.
So, just to get the facts on the table, this order comes directly from the Commissioner General of Inland Revenue, Bevi Perpetua Himali Fernando.
Okay.
And she's using the powers vested under Section 20 of the Value-Added Tax Act, number 14 of 2002. She's essentially changing the fundamental language of commerce in the country.
And the timeline here is super tight, right?
Yeah.
Effective July 1st, 2026, these new invoice formats become strictly mandatory.
Strictly mandatory, yes.
Okay, let's unpack this word mandatory for a second, because it carries a lot of weight here. The government actually tried a softer approach before this, didn't they?
They did, yeah. If you look at the source material, they explicitly rescind a previous Gazette that was Notification Nomen 2463005.
Right, from back in November 2025.
Exactly. And that previous notification was just optional.
It reads like a massive beta test to me. Like the Inland Revenue Department just put the framework out there and was like, hey, maybe try this out.
Yeah, pretty much. But now, it's a hard system reboot for every single registered person. And there's a really good reason for that shift.
Why is that?
Well, an optional tax reporting framework is essentially an oxymoron.
Oh.
If your goal is automation, right?
Because everyone just does their own thing.
Exactly. When a system is optional, Business A might use some sophisticated digital ledger, Business B is still on an outdated Excel spreadsheet, and Business C is literally scribbling receipts on a notepad.
And for a national tax authority, fractured data is basically useless data.
Right. You cannot run an automated oversight algorithm across an entire nation's economy if the inputs are constantly changing shape.
You just end up with this army of human auditors trying to manually translate thousands of different accounting styles.
Which is impossible at scale. So the government is just completely eliminating that translation phase. They are dictating the exact shape of the data before the transaction even occurs.
Wow. And it seems like the very first step in dictating that shape is locking down the identities of the people actually handing the money back and forth.
Yes, the Gazette lays out an extremely rigid physical and digital layout for the top of the invoice.
Right. It says it has to be prominently titled Tax Invoice in bold or highlighted text.
But the real mechanism of control sits just below that title. Right. So on the top left, you must display the supplier's exact 9-digit taxpayer identification number, or TIN.
Okay, that makes sense. The seller's TIN.
Right, plus their name and address. But then on the top right, or directly below the supplier details, you're required to display the purchaser's 9-digit TIN name and address.
Wait, I want to pause on that because that is super interesting. In a normal retail sales tax environment, like if I go buy a TV in a U.S. state with sales tax, the store charges me the tax and sends it to the government. My identity as the buyer doesn't matter to the state at all. They just want the money from the store.
True, but VAT value-added tax is a totally different beast.
So why does a VAT system inherently require the buyer's 9-digit TIN to be plastered right alongside the seller's?
What's fascinating here is that it all comes down to how VAT input tax credits function.
Okay, break that down for me.
So in a VAT system, tax is collected at every single stage of production, but you only pay tax on the value you specifically added.
Got it.
Let's say you run a furniture company. You buy raw wood from a lumber yard, and they charge you VAT on that wood.
Right.
Then you build a chair and sell it to a consumer, and you charge the consumer VAT.
Right.
But when you send your tax payment to the government, You don't want to pay the full amount you collected. You want to deduct the VAT you already paid to the lumberyard.
Oh, okay. And that deduction is the input tax credit.
Exactly.
So to claim that deduction, I have to prove to the government that I actually paid the lumberyard in the first place.
And the only proof the government will accept is a legally formatted invoice featuring both your 9-digit TIN and the lumberyard's 9-digit TIN.
Ah, so it's a financial marriage certificate.
Yes. By mandating both numbers, the government creates a perfectly self-policing closed loop. The furniture maker submits their records to claim the credit. The lumberyard submits their records showing the sale.
And the computers just match them up.
Exactly. The Inland Revenue Department simply cross-references the two TINs. If they match, the credit clears. If the furniture maker claims a credit, but the lumberyard never reported the sale.
Boom. The algorithm flags the mismatch instantly.
Instantly.
It's like two-key authentication for national revenue. One party can't alter the math without the other party's key exposing the lie.
Precisely.
But looking at these identity requirements, there's a quirk I noticed. A bit of a contradiction.
Oh, what's that?
So along with the TIN, both parties have to list their name and their physical address, but listing a telephone number is completely optional. I mean, in a digital economy where this cross-referencing happens in milliseconds, isn't a phone number way more relevant than a brick-and-mortar address?
You'd think so,
Yeah.
but you have to look at what happens when the digital cross-referencing actually fails.
Okay.
When the algorithm flags that mismatch between the furniture maker and the lumberyard, the digital phase of the audit ends and the physical phase begins.
Oh, meaning the tax authority has to actually send someone to go collect the debt.
Exactly. Tax enforcement ultimately relies on physical jurisdiction. If an auditor needs to verify physical inventory, or if the state literally needs to seize assets to cover unpaid taxes, they cannot repossess a phone number.
Huh. Right. You can't foreclose on a SIM card.
No, you can't. Phone numbers can be spoofed, they can be routed through international servers, or just disconnected in 5 minutes. A physical address anchors that digital transaction to a tangible location within the sovereign borders of the state.
That makes total sense. The digital database is just the map, but the address is the actual territory.
Exactly. Though they do offer a tiny bit of leniency at the top of the invoice.
Yeah, suppliers are allowed to add their own logos, trademarks, or additional info in the header and footer.
Right. They can brand the document, so it still looks like their company's invoice. Provided, of course, that those core identity metrics, the TINs and the addresses, remain perfectly intact.
So it allows the illusion of corporate individuality while still maintaining the strict data extraction requirements of the state.
Exactly.
Okay, so the two-key authentication locks down the buyer and the seller. But here's a thought. If a massive wholesaler does like 10,000 transactions a day with the exact same buyer, the TINs alone don't prevent someone from duplicating invoices or even deleting them to massage their tax liability.
Right, because the identities are the same.
Yeah, so how does the government prevent a business from just making up phantom transactions?
Well, that's where the next part of the Gazette comes in. The government forces every single transaction to carry a highly specific tracking code.
Ah, the serial number.
Right. It acts essentially as a mandatory database indexing constraint.
And the formula for the serial number is fascinating. It's basically the DNA sequence of the transaction. It's strictly formatted as YYMM underscore QQQ go underscore colon XXXX.
Yes.
And the Gazette applies two absolute rules here. It cannot contain any spaces, and it is capped at a maximum of 40 characters.
When you look at those two rules, the no spaces and the character limit, you're really seeing the government thinking like a software engineer.
How so?
Well, if you have an unbounded serial number field, the sheer volume of daily transactions across a whole country will cause database storage requirements to balloon, and query speeds will just crash.
Oh, because the servers are trying to read endlessly long strings of data.
Exactly. By capping it at 40 characters, they ensure predictable server loads.
And the no spaces rule is pure database logic, right? In programming, a space is often interpreted as the end of a command or the start of a new variable.
Right. Spaces require escape characters, they create parsing errors, they break code.
So, by eliminating spaces, the government ensures the serial number reads as one continuous, unbroken variable that an algorithm can just digest instantly.
Precisely.
So let's break down this continuous variable. It starts with YYMM.
Right, so YY is the last 2 digits of the year, and MMM is the first 3 letters of the month in uppercase.
So if a transaction happens in July of 2026, the sequence literally begins with 26JUL.
Exactly. And what's brilliant there is that before you even get to what was sold, the transaction is chronologically anchored.
You can't issue an invoice in December and try to backdate it to July.
No, because the chronological anchor is hard-coded into the very beginning of the serial number itself.
Wow. Okay, so following that anchor is the QQQQ section, and this is an alphanumeric code that can be anywhere from 1 to 15 digits long, representing an organizational entity like a branch, a project, a unit, or a customer.
And this is actually a brilliant compromise by the Inland Revenue Department.
Yeah, it feels like a rare moment of flexibility. They dictate the strict chronological anchor, but they give the business up to 15 characters to sort their own internal stuff out.
Right, because a massive corporation with, say, 300 locations, they can't reasonably use a single continuous ticker for all their sales across the whole country. They need to segment their data by branch or region.
So the QQQQ section lets them maintain their own internal architecture. You can label your branches however you want as long as it fits in 15 characters and doesn't use spaces.
Exactly. And then we get to the final piece, the XXXX section.
The purely numeric serial number.
Right. It cannot contain alphabetical characters or symbols. It just counts upward.
And the Gazette notes it continues from the previous month, though a business can choose to restart it monthly or yearly.
To visualize this, the Gazette actually provides a really clear example.
Oh yeah, let's hear it.
Let's say branch 03 of a company issues its first tax invoice in July of 2026. The mandated serial number would be 26JULBR03-1.
26JULBR03-1. Just by looking at that short code, a computer immediately knows the origin and timeline.
Right.
And if, say, 26JULBR03-4 shows up in the database, but number 3 is missing, the algorithm immediately knows there's a gap in the records.
The tracking mechanism is completely airtight. We know the exact identities of the players, and we have the exact database index of the transaction.
Which brings us to the actual money changing hands, the financial nitty-gritty.
Right, because the Gazette enforces the exact same level of algorithmic rigidity on the financial data as it does on the serial numbers.
Okay, so the dates, both the invoice date and the supply date, must be formatted strictly as MMDDYYYY.
Yes.
All values must be in Sri Lankan rupees, LKR. But here's the detail that really shows how precise the system is. All values must be expressed to exactly 2 decimal places.
Including cents.
Right. So even if you sell something for a flat 1,000 rupees, you must record it as 1,000.0.
Mandating those 2 decimal places prevents macroeconomic skimming.
Wait, you mean like the scam in the movie Office Space, where they steal fractions of a penny?
It is the exact same mathematical vulnerability, just applied to tax evasion instead of corporate theft.
Oh, wow.
Think about it. In large-scale corporate accounting, when you are dealing with millions of line items, inconsistent rounding creates massive discrepancies.
So if my internal software casually rounds a tax calculation up or down to the nearest whole number,
your resulting tax liability will be slightly off from what the government calculates, and you multiply that slightly off by 10 million transactions across the economy, the state loses significant revenue.
That's wild. So mandating the 2 decimal places ensures the business's software and the government's algorithm are calculating the exact same figures, down to the cent.
Honestly, and to ensure the math checks out perfectly, the invoice must clearly segment the values.
Right, you need the net amount, which is exclusive of VAT, then on a separate line, the exact VAT amount charged, and finally the total consideration, which is the net, plus the VAT.
And you also must list the mode of payment.
Cash, bank transfer, check, credit debit card, mobile payment, online. If you don't know it at the time, the expected mode is acceptable. But here's something funny. The Gazette mentions that writing out the total amount in words is entirely optional.
Which just confirms that this document is not designed for human eyes at all.
Right.
Writing out 1,000 rupees only is a legacy security measure from the paper check era. It was meant to stop someone from physically adding an extra 0 with a pen.
But an algorithm extracting data from a standardized field doesn't read words. It only reads the segmented decimal value.
Exactly. The words are irrelevant now.
Okay, but here's where it gets really interesting. All of this highly specific rigidity builds up to this one regulation hidden in Section 4.2 of the Gazette, the Golden Rule.
Yes, Section 4.2.
It states, the tax invoice shall exclusively include goods or services only that are subject to VAT.
The rule of exclusivity.
I mean, think about the headache this is going to cause. Wait, if I go to a commercial supplier to buy some office stuff, right? Say I buy 10 items. 7 have VAT, but 3 are legally VAT exempt.
Yes.
According to this exclusivity rule, the cashier cannot ring up all 10 items on the same invoice. They have to generate 2 completely separate transactions.
2 entirely separate invoices.
One invoice with its own 40-character serial number for the VAT items, and a totally different invoice for the exempt items. For a business processing hundreds of customers an hour, that seems incredibly inefficient.
If we connect this to the bigger picture, it validates that frustration, but the inefficiency at the point of sale is entirely deliberate.
Really?
Yes, you're basically trading operational friction for the business in exchange for frictionless auditing for the government.
But why does the algorithm care if a non-taxable item sits on the same digital receipt as a taxable one? Can't the computer just parse the individual line items?
Well, parsing individual line items across billions of invoices requires immense processing power. Not to mention the complex coding needed to distinguish between constantly updating lists of what is and isn't taxable.
That's true.
But more importantly, mixing VAT and non-VAT items on a single document is historically one of the primary mechanisms for tax evasion.
Wait, really? How does blending them facilitate evasion?
Okay, so when you have a blended invoice, a dishonest business can hide the true value of taxable goods by shifting the cost onto the exempt goods.
Oh, I think I see where you're going with this.
Let's say you buy a taxable software package and a tax-exempt consultation service from the exact same vendor. They might bill you 90% of the total cost under the tax-exempt consultation line item and only 10% under the taxable software line item.
Oh, wow. So I pay the same total amount as the customer, but the vendor's tax liability to the government absolutely plummets.
Exactly. It's accounting sleight of hand. And to catch that on a blended invoice, a human auditor or incredibly sophisticated AI has to evaluate the realistic market value of every single line item to make sure the ratio isn't being manipulated.
Which is impossible to do at scale.
Right. So by forcing a dedicated VAT-only invoice, the government guarantees a pure data stream.
A pure data stream.
Yes. If a document carries the tax invoice header and that specific 40-character serial number, the Inland Revenue Department knows definitively that every single cent listed on that document is taxable.
They don't have to parse line items or guess market values. They just read the total consideration field and instantly calculate the liability.
It's flawless, and that requires eliminating all those optional variables.
Unbelievable. So looking at the totality of Sri Lanka Gazette number 248122, the trajectory is just unmistakable.
It really is.
As of July 1st, 2026, the era of flexible, localized accounting is over. They're implementing a perfectly symmetrical, unalterable tracking system. You have the 2-key authentication of mandatory 9-digit TINs locking the buyer and seller together. You have database-optimized serial numbers anchoring every transaction in time and space without a single wasted character.
Right.
And you have an exclusivity rule that segregates data streams to prevent any mathematical manipulation.
And, even if you are listening to this deep dive thousands of miles away from Sri Lanka, this is highly relevant to you.
Absolutely.
Because this document exposes the invisible scaffolding that tax authorities worldwide are currently building. Whether you're operating in London, Tokyo, or New York, this push toward mandatory, algorithm-friendly digital invoicing is transforming how economies function globally. Every time you buy something, intricate rules like these are operating in the background to track the flow of wealth.
It really is the digitization of trust. The state just no longer trusts the business to accurately report its own activity, so they build a pipeline where inaccurate reporting is mathematically impossible, which leaves us with a pretty fascinating and maybe slightly unsettling question. When governments globally mandate that every single taxable transaction must carry a rigidly formatted, cross-referenced digital fingerprint, are we just looking at a better, more efficient way to collect taxes and fund public services? Or are we looking at the foundation, the actual code, being written for a perfectly surveilled economy, where the state knows the exact DNA of your every purchase before you even leave the store?
That's a heavy thought.
It is. And it's something for you to mull over until our next deep dive. Thanks for listening, everyone.